All right, so an outline has been distributed. In all fairness, I finished the presentation after the outline, so there's a little bit in the outline here that's a little bit different than the presentation. There will be no case study or a group project, so you're off the hook. But there are some questions in this presentation, so keep attentive and be ready to answer for a small prize. So, as you already know, after finishing university, I was a financial, advisor. Spent a long time as a financial analyst now, and I lost the words. I was a financial advisor at Scotiabank for a while, and during that time I obtained my mutual funds license. And so a mutual funds license is a license that allows somebody, when registered under a banking institution or a securities body, to sell mutual funds. So that is the license that I have. I'm currently not registered with any bank as I've switched career paths, but that is the expertise that I'm sharing with you today. This presentation is in no means meant to convince you to purchase mutual funds. Instead, my goal here today is to help you understand mutual funds, what they can do and what they can't do, and if this is something that you want. And if you do have mutual funds, so that you're more aware of what is going on with your mutual funds and you can evaluate those better. So do not worry, this is not a sales pitch. Feel free to ask any questions. Being that I've been on the other side, I'm more than happy to share with you everything that I've learned. So our session is going to be broken down into 3 pieces. What is a mutual fund? How does a mutual fund work? And can I own a mutual fund? You'll find that this presentation will review some of the information that we've already discussed this week. So it will help you solidify things that you've learned and see how they apply to mutual funds. So direct versus indirect investing. When we invest directly, you are purchasing individual assets yourself. So this is what we discussed on Monday, where you would purchase stocks, bonds, or other financial assets yourself on the market, and you yourself are the owner. However, there's other options, and that is what we call indirect investing. So that's where you purchase a share in an investment vehicle, and you pool your funds together with other investors you pool your funds together with other investors, and the vehicle itself owns those individual shares. So the vehicle invests directly, essentially on your behalf, and you own shares in the vehicle itself. There's advantages and disadvantages to each of these. When we talk about direct investing, when you're an active investor, you have control. So you decide what it is you're going to buy and sell. You decide how the asset is managed. So a really easy example is when you invest directly, you buy your house. You decide how you manage your house and how your household appreciation, etc. is managed. If you want to redo the roof, you redo the roof. You don't have to ask anybody permission to do that. Direct investing is time consuming. So something we talked about a lot this week is when you buy stocks, you need to research. You can't just take a guess at what's going to happen in the market. You need to spend quite a bit of time understanding the market, understanding the company that you're investing in, and the business that it does, and the possibility of future returns from that business. So all that research, that's time consuming. You're more exposed to loss. So depending on your risk level, when we invest directly, there's a higher chance of loss. There's also a higher chance of return. It's harder to diversify. So when you're investing yourself, you have to do all the work to diversify. You decide which investments you want in your portfolio. Even more time researching when you're trying to get different assets in there. And generally speaking, you need a higher initial investment. So if we look at some of the big companies, one share alone is like $600. Not all of us have $10,000 sitting around to do direct investing. So the alternative would be indirect investing. So the first bullet I have on this slide here is that you can take a backseat role to your investing. For some people, this is a positive, and they like to sit back and have somebody else manage their money, but for other people, this is a negative. because they want to be active in what's going on and they want to understand. I would encourage you to think of this as a little bit more of a negative, because there's nobody that cares about your money the way that you do. Nobody else will. And Dr. Michelle has said it several times now. People who work in the bank don't necessarily, they're not necessarily 4-year degree holders. They are individuals that are doing a job in their 9 to 5. So they're not as passionate about your money as you are. When we talk about indirect investing, you have access to a fund manager, and we'll talk about what that person is a little bit more. You have access to a larger investment portfolio. So when we pool funds together from different people, we get a larger investing amount. It's simplified, once again, if you're looking not to take that active role. And there is management fees, which we're going to talk about a lot, and less control over the assets held by the fund. So what is a mutual fund? I'm curious if you feel comfortable. Is there anybody in the room who holds any mutual funds? A couple. Okay, so for those of you who have a mutual fund, what do you think a mutual fund is? And I know the definition is on the screen, but how would you define it?
Go up and down.
What did you say?
Go up and down.
They go up and down? Yeah, that's a good way to describe what you're seeing on your statements. Anything else?
Other people managing your shares, kind of.
Yeah, other people.
Diversified.
Other people managing your money, and you're getting more of a diversified portfolio. So those are some really good examples of what it might be. So if we think of it as everybody in this room, we could all invest in the same mutual fund and put in a small amount of money, and it's pooled together to make a larger amount of money. And the fund manager is going to take that money away and invest in stocks and bonds that maybe we wouldn't have been able to access on our own, or stocks and bonds that are going to fit our investor profile, et cetera, et cetera. So something really important about mutual funds, and we mentioned this previously this week, is that they're open-ended. So I'll segue into a story here. So when I was working in banking, we had a lovely lady come in who was quite excited about her divorce. And so in the divorce settlement, she had received, I think it was 75% of her husband's investment assets. And so she was coming in to cash in her earnings in the divorce. And she slapped the paper down on the desk and she's like, I will take this in cash today. So sure enough, on the spot, we were able to sell all of his mutual funds and have her walk away with cash. The reason we could do this is because mutual funds are open-ended. So that means every time somebody wants to return mutual funds, the bank buys them back. And every time somebody wants to take a mutual fund, the bank issues a new share. This is different as compared to closed-ended funds, which are like stocks and bonds that we've discussed earlier this week. So you need a buyer and a seller to match. Open-ended funds, because the bank issues new shares, we have to figure out how to set a price. So we're going to use something called the net asset value. And this is the value of all of the funds in, or all of the different shares and assets in the fund. Let me just read my example. So the total market value of the assets held in the fund, less the liabilities that are against the fund, divided by the total number of shares outstanding. So that issue price of the shares of a mutual fund are going to fluctuate every single day depending on the value of the fund. So if you sell when the value of the fund is higher, you will realize a gain, and if you sell when the value of the fund is lower, you may realize a loss. But we have that convenience, so like that lovely client, if you need to sell the mutual funds in a rush, we can quickly convert them. They're quite liquid because they're open-ended. There are different kinds of mutual funds. So on Monday, we talked about the different kinds of investments that you could do. All of these translate over into mutual funds. So money market mutual funds, assets like T-bills, commercial paper, etc. You can have a mutual fund that holds those for you. Fixed income, so that's assets like government bonds or corporate bonds, can be in a mutual fund packaged together. Equity funds, so preferred shares and common shares packaged together into a mutual fund, or an exchange-traded fund as well. Index funds, so this is where we're going to follow something like the S&P 500. And then specialty funds, and that's where we're going to spend most of our discussion today. Specialty funds are funds that concentrate on a specific industry or market. They promise you a specific profile based on your risk. A fund manager. So, like I mentioned previously, I was a mutual fund seller, which is different than a fund manager. So a fund manager is a qualified investment professional who is going to select those different assets that your mutual fund will hold. So I've illustrated it kind of as a truck here. The fund manager is the truck driver, and he's responsible for loading everything in the back. So he's loading in bonds, stocks, money market investments, and other assets depending on the description of the fund. So really, who is this guy? He's a qualified investment professional. They have knowledge and professional judgment to select investments based on the definition of the fund, and they're responsible for the day-to-day management of the fund. So when I was an intern at Scotiabank, one of the things they did is they sent me to Scotiabank Cloud for a day. And there I met several fund managers who managed various funds. They didn't necessarily manage mutual funds in that office, but they were managing portfolios of wealthy individuals. And so a fund manager would have a team of 5 people. So he had 2 people, and their job was to sit at the computer all day. And when he said, I want this traded, they would trade it. And that was their job. They were typing on the computer constantly, trading, buying and selling stocks on his behalf. Then they had another 2 people who were responsible for reviewing company information. So these individuals are constantly doing research. They're looking at what kind of funds they want to hold, how is the market moving, what is the economy looking like today. And then the fund manager himself was responsible for having those client relationships and making the final decision. So while we may say it's just one fund manager, it's usually about a team, it's about 5 people, a team that they're working with to make these management decisions. Keep that in mind later on when we talk about management fees. So not just one person, usually a small group. So the advantages of a mutual fund, specifically, diversification. So like you were talking about, you're going to hold different assets in that fund. Convenience, it's easy to buy, it's affordable. Like we said, you can start with a small minimal investment, and it's pulled together with other people. It is easy access to your money, professional management, and access to markets. So like I said, I do have quiz questions in here, and we do have prizes. So this will be our first question. Which of the following is not an advantage of a mutual fund? Indirect investing, the ability to take a backseat on your investment and save the time and energy that you would have devoted to research and analysis. It is closed-ended. The shares of the fund are bought and sold at fair market price, determined by the rule of supply and demand. Professional fund management, an experienced investment professional who oversees the assets held by the fund. Affordability, funds from multiple investors are pooled together to increase the buying power of the fund, meaning that you don't need to have a large sum to start investing. So A, B, C, or D, which of these is not an advantage of a mutual fund? Well, I heard it here first.
I'm going to say B.
Yeah, that is correct. We have an answer. It is B. A mutual fund is open-ended. That means that we can buy and sell at any time. Some of you said indirect investing, but this is actually a benefit of a mutual fund. Indirect investing means that you are trusting a fund manager to invest for you rather than doing it yourself. So if we could get a prize to this lovely lady over here.
Right here. Aw, thank you.
Thank you. So let's get to the part that you're probably curious about here. How do you make money? Especially if you're owning a mutual fund, you may have questions about if your fund has actually appreciated over the past few years. So based on the fund type and description, fund managers are going to invest that pool of money in a variety of assets. Their main goal, it may shock you here, is not necessarily to make a huge return, but actually to meet the investment objectives set out in the mutual fund prospectus. Prospectus is a really big and intimidating word, but this is the document that you get when you buy the mutual fund. Usually it's a nice laminated PDF and it has charts and graphs and colors, etc. That is because they desperately want you to read it. It has all of the information about what's going on in your mutual fund. And you can rest assured that that information is true and is laid out in a specific way for you as an investor, because these prospectus are presented to the securities commissions every single year. So annually the prospectus is filed with the Securities Commission. The commission says this is good. You can continue to share this with your individual investors. When you're reading this, there's 4 things that I want you to look for. Fund fees. So it will break down exactly what fees they're charging you. Now, like I said, it's pretty, it has the graphs and the charts, etc. Read the small print. That will tell you exactly what's going on with those fund fees. So while the graph might look pretty, and you might see a little bit of things, under that might be a little bit of an explanation of what is really going on with those fees. And we're going to talk a little bit more about fees. The other thing I want you to look at is the investment objective. So just now I said that the objective isn't necessarily to appreciate a huge growth all the time. We can have investment objectives that are quite a bit different. So if you're investing for retirement, you may hold a mutual fund, or they may recommend to you a mutual fund that doesn't necessarily experience a lot of up or down, but instead it collects a lot of dividends. So they're trying to get income for you. So your mutual fund is paying you dividends each time. The stocks that are in the fund issue dividends to their shareholders, or bonds are paying interest your way. Another thing to look at is the fund risk. So you don't want to buy a fund that's riskier than you are, because then you are going to see those big ups and downs, and that might not be something you're comfortable with. And then there's going to be a lot of other little details in there. Sometimes they're specific to your fund, including other hidden fees that you may not have thought about. So take the time, read the prospectus. If you're in that office and you're buying mutual funds, ask questions, point to different things on there, and ask them to walk you through every piece of that paper. As someone who previously sold mutual funds, that was something that we spent a lot of time doing. When you work in banking, you get quite good at explaining the small print. So it's very easy for us to jump to the sections that we know we have to talk about. So as an investor that's responsible for your money, it's important that you stop that financial advisor and tell them, no, I want to understand this part and this part as well. Nobody cares about your money the way you do. So fund fees. Fund fees are usually the most intimidating part about mutual funds, but unfortunately not the thing that they think about. So I'm curious, for those of you who said you hold mutual funds, have you looked at your fund fees before? I got one nod. Others of you maybe not. That's fair. So let me break it down. Management expenses are the fees that we charge that are associated with running the fund. So remember when I told you that when I was at Scotia McLeod, there was 5 people sitting in the group? All 5 of those people need to be paid. Usually they're paid using a management expense ratio. So this is a percentage of the fund earnings that they are going to take for them. Now here's the interesting thing. If the mutual fund earns a return of 8%, and my management expense ratio is 2%, you as individual investors only earn 6% because we got to pay the management. Interestingly enough, when you get your mutual fund statement, you probably won't see that you paid management. You'll see that 8% on there because that's what the fund earned and that's what they want to highlight to you. However, that small print I was talking about, if you look down there, it will say, hey, and we paid 2% to all those amazing people who are making those decisions for you. So don't be deceived when you're reading that statement thinking that your return is quite high. You paid fund managers for that return, and so that 2% came out of your earnings. If that's something that you don't like, or something that bothers you, you can also look at exchange-traded funds. And so exchange-traded funds are similar to mutual funds. However, we don't have that group of 5 investment professionals. Instead, an exchange-traded fund is mirroring a given portfolio. So they can be specific. So you might have an exchange-traded fund that is always going to invest in the top 10 performing companies in agriculture, for example. Or you can have an exchange-traded fund that is going to mirror an index. So there might be an exchange-traded fund that will always invest in the top 500 S&P index. So the top 500 companies on the TSX, that exchange-traded fund is only going to invest in those. This is different than a mutual fund because the decisions are made in advance, so fund managers are not working as hard. They're just doing those trades. They're not researching new companies to hold in the mutual fund. A little bit of a contrast there. So exchange-traded funds are going to have a much lower MER, which is that management expense ratio. Sales fees.
So what is the advantage? Besides the lower fees, what is the disadvantage?
The disadvantage of an exchange-traded fund is you don't have somebody making those management decisions. So hypothetically, with an exchange-traded fund, you're more likely to move with the market, depending on what exchange-traded fund you have. Whereas with a mutual fund, hypothetically, because your investment manager is so amazing, you should be still moving with the market, but hypothetically doing a little bit better. Yeah. Exactly. So he's saying that there's a distinction knowing that it's all the profit that's made in the fund, if I'm getting it right. So it's not just your measly 2% that they're taking, that's 2% from the entire mutual fund. So they're making quite a bit of money when they're doing a management fee. Something else to think about, and it will be in the small print of your mutual fund. Generally speaking, sometimes mutual funds will experience a loss year. Unfortunately, for mutual fund holders, we still got to pay the fund managers. They still work that year. So usually your loss might be a little bit more because you had to pay somebody else. So you're losing, and then you're losing on top of that, which is usually something that investors don't feel comfortable about. But once again, being the impartial party in this chat this morning, I'll remind you, they actually still worked that year. So that is why they're taking that money from you. I'm going to move to the next category here, which is sales fees. So sales fees are the ones that would have come to me as the person selling the mutual fund. So this is the commission or service fees for dealers and advisors who sell mutual funds. Selling a mutual fund is much different than selling a stock. Selling a mutual fund is, or can be done by a financial advisor. So you come into the office, we talk about your investment goals, we talk about your risk portfolio, your money and what you want to do with it. And then we can recommend a fund and sell that to you. Mutual fund advisors in banks usually sell that bank's mutual funds. So if you're looking to invest in a mutual fund and you trust your bank, that is a good place to start because they're going to sell you mutual funds from your bank. Bank managed mutual funds generally perform better than small investment company mutual funds. And this is because banks make money. They always do, whether or not you're making money, the bank is making money. So generally speaking, they perform better. Sorry, there's a drip. Move that over. So I'll tell you something. When I worked in Scotiabank, they gave me RRSP, an employee RSP, and they told me I could choose if it was market invested or just sitting in whatever else. And I said, well, you guys are Scotiabank. I'll go with the market invested. You invested for me. We'll see what happens. Then after I left banking, I was like, put $200 in there. I don't need that. And I took my $200 out. But I thought I closed the account, but it turns out I didn't. So about a year later, I get this statement in the mail, and it tells me that the interest on my $200 stayed in that account. Well, Scotiabank was investing that interest, which was $25 at the time, and somehow it had appreciated to $100 over the year. And then, as the years went by, I kept getting these statements, and suddenly my $100 was $200, and $200 was $225, and I was like, I kind of made a good decision here letting Scotiabank invest this money, even though I thought I had closed the account. So, generally speaking, there can be some advantages to having a good fund manager invest your money. Not always. Like we were saying, in years of losses, you're losing money. But sometimes bank mutual funds can have their ups and downs. An example that Dr. Michelle was telling me about was BMO. The BMO has some well-performing mutual funds that have done well over the years. So if you are thinking about a mutual fund, I would recommend that you stick with one of the bigger banks. The reason I say this is because if you have an individual investor account, so you have like Investor's Edge or an iShare account, and you go to the market yourself and you're doing direct investing, you have the option to buy mutual funds in those accounts as well. It's also there that you would buy exchange-traded funds. Now, if I'm managing my portfolio myself and I'm investing all my time and energy, why would I buy a mutual fund? Does anybody know one reason why I might still buy a mutual fund? What was that?
Safety net?
Safety net? Possibly, but probably not in that situation. That's not the best reason. Anyone else have an idea? Diversity, you're like right on the cusp of it. It's that there are markets that I can't access. So maybe I am interested in US securities or Chinese stock market, but I don't want to open an investor account in those markets. I can invest in a mutual fund that is going to hold shares from those markets. That is the main situation where it makes sense for you to hold a mutual fund in a self-directed account. When I was at Scotia McLeod, they let me peek onto people's desks and see what they were doing, and I noticed right away that one of the funds that they were managing held a mutual fund, and of course I was like, oh, you guys, you're holding mutual funds. You can't be holding mutual funds. You're fund managers yourself. And they're like, oh, no. When we want to invest in foreign markets, we buy mutual funds. So there's a secret for you. Instead of investing in foreign markets directly, you can buy mutual funds from foreign markets. Do your research, find ones that are performing well, but it's a way of indirectly getting involved in the world market. The last category I have here are special fees. These are ones to watch out for and read up on. They apply in specific situations. So when you transfer a mutual fund from one institution to another, there's a lot of extra paperwork that's involved. Therefore, we pay some extra fees. When you do short-term trading, there's extra fees. If you have a trustee account, there's extra fees. If you are setting up a new account or closing an account, we have processing fees. Especially if you're closing a registered account, then there are tax documents that need to be filed, processing fee. I want to circle back to short-term trades for a second. If you buy a mutual fund, how many days do you think you have to change your mind? Any guesses? You can fit the number on one hand. Somebody throw up a number.
5.
3,
5.
5, 2. Usually you have 2 days to change your mind. So in that 48-hour period, sometimes it's actually 3. you can run back to the bank and say, oh my gosh, we're not doing this. Undo, I don't want it. After that time period though, the fund manager has your funds, they're pooling them together with everybody else's, and they're ready to invest. And so if you pull the plug, they're like, hey, we already did work for this money, we're gonna charge you a fee. So 2 days, sometimes 3 to make up your mind and pull that out. So keep that in mind the next time you're investing. If you need to, call back and be like, hey, no, I don't want this, or I want to do something different with this. In order to avoid a short-term trade, it's written in the prospectus, but it's usually 30 to 90 days that you need to wait before you sell off a mutual fund. After that time period, you can sell them off quite quickly and convert them back to cash. So, how do you,
What are some of the standard percentage of fees? And do they vary between banks or among banks?
They will vary among banks. So banks will carry different mutual funds, and depending on what is written on the prospectus for those mutual funds, as in what the fund manager is promising to do for you, the fees will go up and down. So on the lower end of the ratio, they might be about 2%. On the higher end, you can see all the way up to 12. So it depends on what they're saying they're going to do for you with that fund, which is why it's so important to read, because you might purchase a mutual fund thinking that, oh, this is so amazing and it's going to perform so well, and they're promising these huge growth potential. There's a reason for that. And so the reason is usually that they're promising to commit extra time and research to looking at what they're doing with that fund. So generally speaking, we end up on the lower range around that, like 2%, sometimes even lower than 2%. But they can spike up, so you want to look for it. Usually you're at the most risk when you tell the bank that you are a high-risk person and you're looking to make a high return. Then what they're hearing is, you want us to do a lot of work. And a lot of work means paying a lot of fee. Between banks, though, I wouldn't say that they fluctuate too much. The big 5 banks, so TD, Scotiabank, Bank of Montreal, Royal Bank, yeah, that's one, and the last one is RBC?
Yes.
CIBC, there we go. I said Royal Bank already, yeah. So those big 5, generally they're going to have a lot wider offering of the mutual funds that they're doing. They may be doing mutual funds that other people from other countries are investing in so that they can access the Canadian stock market, if you think of it that way. So they will have that wide range of products across all of their banking products. I know sometimes it feels like those banks are quite small because we're used to seeing them all the time, but they're very large. The size of TD will shock you. The fact that Scotiabank actually has branches in other countries might surprise you. These banks are very big and very active. If we talk about making money, there's 3 categories here. So there's capital growth. That's when the securities that are held in the mutual fund appreciate, but we haven't sold anything yet. So when they appreciate like that, there is growth, but you haven't realized any gains. When we have capital gains distribution, that means that the fund manager sold a stock that had appreciated and made some money. And so that rise in value is distributed to the mutual fund holders. And then we have income distribution. So this is income from interest on bonds and dividends on preferred shares that is then distributed to mutual fund holders. So only the last 2 there actually involve a distribution of income to you. So when you get that income, you're probably wondering, do I have to pay taxes? And also, where does it go? So this depends on where you hold the mutual fund and what you've told the fund manager. So the where does it go question. When the mutual fund distributes earnings to you, you have the choice. And you told the fund manager what you wanted that to be. So you can tell them A, you want them reinvested, or B, you want them paid to you directly. If you're like me and my employee RSP, I said just reinvest it and keep it in the fund, and that's how it appreciated. However, you may be in another situation where this is your retirement savings, and so you want that income distributed to you. You want your money making money. Now, I'll tell you about an interesting story. When I was working in Sherwood Park, there was a family that had come in and they had quite a good, healthy amount of money, but they didn't want to have their money make money. So, as a general concept, money makes money. The more you invest, the more you get return. You need money to make money. This family in particular didn't want their money to make money. And so it was actually a challenge to find a way to have their funds maintained without earning any money. So they were in a large mix of banking products that didn't earn any return. And it was such a complicated case because naturally money makes money. When we invest, there is always going to be a return in one way or another. Something interesting to think about is you can invest money in things other than stock markets and bonds and all of these assets. You can invest in yourself. So for example, I invested in my education and now I work and I make money. Money makes money. There's really no other way to put it. So when you're investing, your funds are going to generate some kind of return. That being said, it will not be a rapid return all the time. I attended university for 4 years. It was rigorous. It was downhearted. Sometimes I was downtrodden. But later on, it did come back to me. So your money is going to pay out. Depending on where you hold your mutual fund, you may have to pay taxes. So I would recommend using one of my favorite illustrations. I would recommend to you a registered savings plan and especially a tax-free savings account. So these accounts are like umbrellas and the tax is like the rain. When we use these accounts, we are sheltered from the rain, so we're sheltered from tax. With the tax-free savings account, you don't pay any tax whatsoever. And with a registered retirement savings plan, you're deferring that tax. Now, there are other savings plans. If you have a child, you may want to look at a registered education savings plan. So this is a plan where you can put money away for them to attend university. It can earn a return. And when they go to school, they can access that money. If that scares you that your child may not go to university, you can also pull that money back out if they decide not to go. There are some fine prints associated with pulling that out, but you can recover your cash. So when we use these tax-sheltered plans, we're able to shelter ourselves from tax. You may, however, make the decision to invest outside of a sheltered account. And so when you invest outside of a tax-sheltered account, you will be taxed. So if you realize capital growth, you'll be taxed on the gains when you sell the mutual fund. So remember, the mutual fund is evaluated, so you get the value of the mutual fund at the end of every day. So if the mutual fund grew between yesterday and today, and you sell today, that change in mutual fund, you have to pay tax on half of the gains. Gain distributions, so if you're taking that where the mutual fund or the fund manager sold mutual funds, that income that's distributed, once again, you're taxed on half. And you're taxed at your current tax rate. So that means that if you're in retirement and you're earning a lot less than you used to, you're going to have a lower tax rate, and so that won't be as hurtful, really, because taxes hurt. But if you're at your high earning potential, your maximum earnings, that tax rate is going to be a little bit higher. So if you're at that high earning potential, you may want to think about keeping your money reinvested instead of realizing those gains. And then any interest distributions is fully taxed. In Canada, we have eligible corporations that have an associated tax credit, and I don't want to get into the details of that today, but something to look at when you're investing is Canadian companies because of that tax credit. Fund performance and structure. So every year, if you hold a mutual fund, you get a statement in the mail, and it tells you about your fund performance. You don't need to wait to receive that statement to know how the fund is doing. Funds are tracked in real time. You can see them online. You can see them on the website of your mutual fund company, or you can even read them in certain newspapers. And you might see something like this, along with a lot of other information. But I just want to highlight what's on the screen there. So the price changed from one day to the next. How much has it appreciated between today and yesterday? the percentage change over a 30-day ratio, a 3-month ratio, a 16-month, a 1-year, a 3-year, and then since its inception, so from the date that the fund was created, how much has it appreciated? There's a couple other indicators that are going to be on there, but you can also track fund performance against other things. So you might want to benchmark it against how the market itself is performing. So I keep saying it, the S&P index is a really great one to compare your fund to. How is the mutual fund performing compared to the market that it's in? If you have a specialty fund, how is it comparing to the other assets that are in that market? How is it comparing to the competing mutual funds? So a lot of times, the big five will have similar mutual funds, each one. Is your BMO mutual fund doing as well as the TD equivalent? You can compare those side by side. So when we're comparing, we don't want to just look at only our fund, we want to look at benchmarks to compare them to. Something to be very cautious of is that past performance does not mean future performance. So if your fund did amazing for the last 20 years, guess what? That fund manager is probably ready to retire. And so when he retires, it may not do so great. So your fund performance from the past does not mean it's going to be amazing in the future. You can use it and compare it to benchmarks in the marketplace. So you might say, okay, back in 2007, I knew there was a big recession. How did this fund perform? Dr. Michelle hinted at earlier this week that there are some stocks that perform well when the market crashes. Is my mutual fund one of those stocks that's going to, or does my mutual fund hold stocks that are going to perform well when the market crashes? So you can go back and look at those indicators, but the past does not equal the future, so use caution. The asset allocation is the mix of assets in your mutual fund. So you'll have equities, which are stocks. You'll have fixed income, like bonds, and then you'll have some cash. When I say cash, I don't mean like the $20 bill. You'll have cashes in money market equities, so equities that can be quickly liquidated. These are important for the fund manager because your mutual fund could be sold at any time, so we've got to keep some liquid in there so that they're ready. So we're coming up to a question here. This is a true-false, so you just have to find the statement that is false. And we do have a prize again. So which one of the following is false? Capital gains are only taxable if you sell your shares of the mutual fund. Otherwise, these gains are considered unrealized. The fund structure relates to the asset allocation. This is the mix of equity, fixed income, and cash. Registered accounts like an RSP or TFSA can shelter you from paying taxes on money you made from your mutual fund. All mutual funds have hidden fees. These fees are not disclosed to buyers when they purchase their mutual fund and can impact their ability to make money. D, yeah, you're right on the ball. D is correct. So all mutual funds do have some small print fees, but they're not actually hidden. Because of the securities regulator, they've got to tell you, which is why you got to read that prospectus. The information is actually there. It's not a mystery. So we're going to move into the last section here. How do you own a mutual fund? Once again, my role here is not to sell you a mutual fund, but to tell you how you can acquire one if you want to get one. So something I want to focus on really quickly is the risk and return trade-off. So this is the idea that the higher the risk you take on, the more return you can make. Lots of times there's very small startup companies. We don't know if they're going to be quite great. I'll use an example from pop culture. So I read an article about Jay-Z and Beyonce. And they went to do a concert, and the event promoter said, well, it's been really great having you. We could pay you in cash, or if you're interested, we'll pay you in shares of this small startup company that you may have never heard of. And they were like, ooh, okay, we'll do it. Who knows? It might be good. This company ended up being Uber. So from the small, exactly, from those small startup shares that they took, they appreciated dramatically over time, and they made quite a bit of money off of this investment. So the risk was there. Had Uber crashed and failed, they probably wouldn't have been paid properly for their concert. But because Uber took off, they appreciated their earnings quite a bit. So when we take risk, we can earn a higher return. Jay-Z and Beyonce are like millionaires. they can take that risk. If they lose their money from their one concert payment, it's not going to impact their lives. However, you yourself may not be a hot rising pop star. And so you may not be comfortable taking that kind of risk. And that is okay. You yourself have a unique risk profile. When you read your financial statements, you may be comfortable seeing high ups and downs, or you might prefer to see a fairly steady line. And that's okay. So we're going to talk about the different types of risks. So when we invest in foreign countries or foreign money, there's a currency risk. When we invest in bonds, there's a creditworthiness risk. So that means that in the same way as lenders are hesitant to lend to you because they're not sure if you'll pay it back, you should also be hesitant to purchase the debt of other companies because you're not sure they're going to pay it back. We like to say that the government, so T-bills, treasury bills, are the lowest risk because the government is not going to default on those treasury bonds. However, other companies might. Bonds usually have a rating, and so higher rated bonds will be more self-sufficient companies that are less likely to default. Lower rated bonds, more earning potential, more likely that the company itself is just going to crash and burn. Interest rate risk. So the value of the bond will drop when the interest rate rises. Liquidity risk, how fast can the investment be sold? And then market risk, stocks are always going to suffer some variation of up and down. So stability of your investment can fluctuate a lot. Coming back to this top one again, foreign investments, political situations happen in foreign countries that we're maybe not abreast of. And so, for example, with the war in Ukraine, that is a sudden change that will change the value of the assets in that portfolio. So we're going to do a group exercise. Like I said, no group case study. This is the replacement. So we're going to evaluate your risk tolerance together. So I have a series of 5 questions, and I want you to remember the color of your answer. So the first question is, your best friend, says his uncle, will give you a chance to invest in a golden property in northern BC. Mountains, rivers, picture all the blingy stuff. He says the investment will double before the end of the year. What do you do? Are you somebody who thinks about it and then decides not to invest? Do you invest $1,000 because it's $1,000, what are you really losing? Or are you going to get information about the company, and then if there's potential, you'll put in $5,000 because you've done your research? Or you really like uncle, you really like your best friend's uncle, and you drain your savings account and you're going to buy as many shares as possible in this company. So take note of whatever color your answer is. And there's no right or wrong answer on these, just note the color. All right.
I'd say the second last one.
No right or wrong answer. Just note what color you are. So second last when you're pink.
I'm just gonna let you guys do this one. It will be complicated here.
Oh yes. If somebody could assist, that would be good. The order of the colors is blue, green, pink, yellow. So if you're A, you're blue, if you're B, you're green, and if you're C, you're pink, and D, you're yellow. And the order stays pretty much the same. No right or wrong answer, just what you want. So the next question is, your boss is going to pay a year-end bonus and gives you a chance to choose between $500 cash or $600 in company stocks. You can't sell the stocks for at least 12 months, so you gotta wait to sell the stocks. And in the time that the stock price, it could go up or down, so we have no guarantee. What do? Do you take the money while you can? Do you want the cash in hand today? And that's a blue answer. Or do you take the stock because you believe in your company's potential? And that's a pink answer. So only blue or pink on this one. Note what color you would feel. And once again, no right or wrong answer. So take the money is blue, and take the stock is pink. Question number 3. A friend invites you to join a hockey pool with a $20 buy-in. So you could win over $500 on your $20, and I know it's kind of gambling, but imagine here. What do you do? And so as Adventists, this answer might actually be influenced by our beliefs. So this is something to keep in mind when we talk about risk. Your beliefs are also a factor that's going to contribute to that. So in blue, do you say no thanks to the hockey pool investment? In green, do you ask a friend to split the costs since a $10 loss is better than a $20 loss? In pink, do you make some educated guesses and place your bet? Or in yellow, do you find out if you can purchase tool pools and increase your odds of winning? So blue, green, pink, or yellow, note which color you would do. Question 4. Your parents decide to give you an early inheritance of $10,000, asking that you invest it wisely. What do you do? In blue, do you buy a high-priced item you've had your eye on? Sounds money, sounds like a car. Do you put the cash in a safe term deposit earning 2% a year? So in green, do you put that cash in a safe deposit and you know it's going to be there for sure when you come back? In pink, do you get a financial advisor to help you diversify your investments? So maybe you're going to make an appointment at the bank and you want help to make sure you invest this money wisely. In pink. Or in yellow, do you invest it all in a startup company with huge potential rewards and risks? Which one are you more likely to do? Which one would you do if this was you in this situation? The blue, green, pink, or yellow? The very last question. Question number 5. A stock you bought over a year ago has suddenly increased in value by 40%. What do you do? Do you sell and move your cash to a lower investment? So in blue, would you sell that stock right away, realize the 40% gain, and then move your cash to something more secure? In pink, do you consider selling enough to cover your original investment, so you just want to make your money back? It's okay that appreciated, you're still going to leave some money there, but you need to make your money back now. So that's pink, but there's no green on this question. Or in yellow, do you borrow money and buy even more of the stock? If it appreciated by 40%, who knows what will happen next? So would you borrow money and buy even more? So if you answered mostly blue, you are risk adverse. You are a person who doesn't like to take risks with your money. You like to know that money is solid and guaranteed. And this is okay. So like I said, there's no right or wrong answer here. Risk adverse is okay. It's actually ideal if you are retired or saving for a short-term investment. So if my short-term goal is to buy a car and my current car has the muffler dragging on the ground, happened to me recently. If that is my situation, it is okay that I am risk adverse. I need to be sure that that $4,000 to replace the muffler and the car, it's going to be there when I need it. I don't want to have that locked up in some high-risk investment. This is also really good if you're retired because that is your life savings, and so you likely don't want to see large ups and downs. Also, when we're risk adverse, it also likely means that we want to draw from the portfolio. So really important that short-term our principal is maintained. If you answered mostly green, you're moderately risk adverse, so you do quite a bit of research before you make any investments, and you're a little bit more hesitant about putting your money into something that's not a sure guarantee. If you answered mostly pink, you're risk friendly. So I like to think of the pink as the educated investor. So you're well advised, but you're comfortable maybe taking that extra risk. You're taking very calculated risk with your money. And then if you answered mostly yellow, you are a risk friendly person. Good for you. That's amazing. That means that you are comfortable investing and seeing short-term fluctuations because you feel in your heart that you are going to receive that long-term investment, that long-term payoff. And that is awesome. If you are in your early 20s and you are investing for retirement, it is okay to be risk-friendly. There's a good amount of time in there that you have to experience the ups and downs of the market. In my office, in banking, we used to have this poster, and the purpose of the poster was to show people that over time the market does appreciate. And so on the poster, we had different lines for every different part of the market. And the point we were trying to illustrate is if you had invested in all the best days of the market, your investment would appreciate significantly. However, if you had stayed invested for a long period of time, your investment will also appreciate as well. So when we have time on our side, it is okay to be risk-friendly. That is all right. However, if you're reading your statement and it's scaring you that it's going down, even in your 20s, you're still risk-averse, and that's okay. The last few slides here are resources, and so if you really do want to hold a mutual fund, and you feel that this is something that is meant for you and you'd like to take more of a passive step in your investing, you can talk to your financial advisor. As I mentioned before, buying mutual funds for the big five is probably the safer decision than going with a small mutual fund company. And so you can make those appointments at your bank. They will take you through a series of questions to assess your investment goals, the size of your portfolio, all of that fun stuff. Rest assured that this is a banking program and not the person sitting there giving you the advice. When I worked at Scotiabank, we definitely had a long, beautiful slideshow, and we'd have to turn the whole monitor around and type in information with you to show you the calculation. It wasn't something that I was doing on a piece of paper. So they have this program. They're able to walk you through your savings goals and assess what portfolio might be best for you. That being said it once, I'll say it before, nobody cares about your money the way you care about your money. So do your research, read up on everything that they're telling you. And then finally, resources. So your financial advisor is a huge resource. You can also find information on your bank's website. If you are planning to book that financial advising appointment, read before you go in. Impress them with your knowledge and that you know when you are invested in your finances, and they will give you better advice because they'll see you as somebody who understands what they're doing. Online, if you see any banking terms or investment terms that you don't understand, Google them. There's this wonderful website called Investopedia where you can find out what those terms mean, and they explain them in plain English, and you don't have to be intimidated. Don't be intimidated by your finances. Take the time to understand what everything means. Read your prospectus. Not only the colorful parts, take the time to also read the small print, understand what those fees are, know what it is. They're required to disclose it. It's not a secret. The information is there for you. Review your annual performance documents. Don't just read the document that comes in the mail. Compare it to how other funds are doing, how the market is doing. Are you actually making a return? Are you comfortable paying the fees that you're paying? What is your role in your investments? And then finally, there is the Alberta Securities Commission website. If you think that you're being untreated fairly in any way by your bank or by your mutual funds, you can register a complaint. You're not passive, you're not a taker in this situation. You can speak up and speak out. And that's all I have for you today. So thank you so much for listening. I'll open the floor for questions.
Something that I've thought about over the years, never, pretty much, but for what ethical, like these mutual funds, like, how do you find out if you don't necessarily invest in a company that's making money on something you don't do?
That's a really good question. So when we talk about mutual funds, if we want to know what's in the mutual fund because we have ethical beliefs, which means that we may not want to invest in specific companies, on that annual report and in the websites for the annual reports, they have to list every single company that the mutual fund is holding. So it's there that you would review the individual companies and say, oh, no, this doesn't align with my beliefs. Additionally, when you're purchasing the mutual fund in the prospectus, it will tell you the purpose of the fund. So if you want to ensure that you're not holding a company that goes against your belief, ask the question and read that definition. If they say they're just going to hold the top 500 funds, there's a good chance that there might be something in there that doesn't align with your beliefs. For sure. Any other questions? Yeah.
I have my own simple definition for mutual. So I benefit, the manager benefits. But so the question is, why is it that when I lose, the manager still benefits?
Benefits is a nice way of putting it, and they do benefit, they get paid. And so something else to think about is when a mutual fund performs really well, there's usually another threshold in there where if a mutual fund performs over a certain percentage, that manager gets a bonus, which is unfortunately more money that they take from you. But that's additional money that they get. So regardless of which, that management ratio is meant to pay the fund managers for the work that they did. So even if they did a crappy job, unfortunately they still showed up at their job. So you end up paying them anyway.
The money is mine, so it's really not mutual.
The mutual is not so much to define the fund manager, but the fact that all of us in here can pool our money together mutually and invest in funds. Yeah, unfortunately, we do lose out on that fee.
Yeah, I was just going to comment too. The mutual doesn't apply to the manager and you. It applies to the fellow investors. The manager, he will get a portion even if you get nothing.
As we've been seeing interest rates going up, do you foresee, personally, think that will continue, and how do you also recommend to maybe get out of bonds, like you were saying?
Ooh, I'm going to throw that question to our economics professor in the room.
Well, we can. That is part of what this would be called fundamental analysis, which is that we analyze the economy. As Brian was presenting, I was thinking about Western Europe, for example, how the market is doing, and what is the possibility of investing in German companies or French or nothing like that. If you are a risk seeker, then you will try to wait until you see some of the companies going all the way down and make public business. That's what a risk seeker does. There's always an opportunity. And if you're a risk averse, you would say, right, what is the possibility of compensation if I go there? And then you follow the trends. And another thing, as a result to your question, I see we are witnessing a kind of shift in the world economy now, where you see a split. Some people believe that all the US is going down. The US is going down anyway. The thing is that you're going to have a kind of more all the powers coming to the market, Asia, potential Latin America. So if you're diversified, you're interested in international investing, you will look at the Asian companies, some blocks from in there. There is always some potential. We could look into that. So what we see, we're going to see at least another pool. Instead of one economic pool, you're going to see two or three. There is always possibilities for the investors that all these goals. In North America and Asia, there will be opportunities. So I don't panic.
Okay, I guess when I became an Adventist, I came in a very conservative situation, influence. And so I heard people say, well, this is, and I've never checked out. And I don't want to offend anybody because I think this is valuable information, but there seemed to be an attitude amongst my fellow believers at that time that investing in stocks and bonds was something that the Spirit of Prophecy had not recommended. Because, and I remember some people, as soon as as soon as the sun went down, they went and grabbed the paper to find, it became kind of an obsession. So I don't know if you can address, I don't know if I'm putting the question very well, but I would really like to just have a take on that, if you could. Thanks.
That's an excellent question. I don't know if the president wants to address it. But I have a friend, a colleague, who told me, She's from third or fourth generation in our church, so the other church, and his grandfather never planted even a coconut tree. Saying that everything is in, and I'm not going to do that. So,
Raise the mic. Raise your voice.
Oh, okay. So on Monday, I was saying that on my first day going teaching investment course at CUC back then, and I met a colleague on the stairways, and what class are you going to teach now? I said, I'm going to teach investing. And he said, oh, you're going to teach our kids to gamble. It's not gambling. It's absolutely not. so there is a social value. If you were to help someone else, which is one of the key value of our community, then you will need to learn how to help yourself. You see, I don't know if I'm going too far, but you need to work and increase. It's perfect. It's very. I'm not, the expert, but it's very biblical according to me that you work and you increase your wealth so that you can help your community. It's the way I see it.
I think you addressed both extremes, and to invest, if you're doing it, that you're putting your money into a business and you're sharing in the rewards of that. That seems to be a very biblical thing. There was the story of the talents, and one got so many, and somebody got so many more, and the one who made the most, he got the benefit of investing even more. So, so I don't have an issue with it. You can gamble. There's day traders and that kind of stuff, and I wouldn't encourage that sort of thing, but to just purchase something and benefit from that, is a business adventure, just like any other. Many Adventist-owned companies and businesses, and that's probably a bigger gamble than buying shares in Royal Bank. And so I think you can get the extreme where then, you're at it 24/7, buying and selling every day, and day trading and all that stuff. I would say that's more on the gambling side.
Thank you. Other questions this side?
No more questions?
Okay.
Wow.
Yes, Ian?
Oh, we have a couple more hands this side.
Oh, okay.
I just wanted to make an observation, if it might be helpful. I started buying shares in my 30s because my wife and I, we had our 5th child when I was in my early 30s, and I knew that we would be a one-family income for quite a while all the kids are being raised, but we wanted to put them all through church school, college, and all of that. And I knew that as generous as the church is with my salary, that it wasn't going to support all that. So I bought some books and started reading and started investing. And it has taught me and served me very well. And so a year or so ago, someone asked, how much did you use, money did you need to educate, because all 5 now are done university. And I calculated it, including church school expenses. Kingsway is where we sent them when they got high school, in many cases, because that was the place that was nearest. So I calculated we did $300,000. That's what it cost us to educate 5 kids through university. And so every fall, we would, whatever savings we had toward, at one point we had all 5 in school. We figured out what we needed to send to Kingsway and to different schools. And whatever we were short, I would go and take the money from the investments. And so that's what got us through school. So that was a great thing. And now, of course, it's continued into retirement. So that's why I think investing is a great thing, done sensibly. I will make another comment for whatever benefit this is, another observation. That is, there's a school of thought out there that says When you're younger, you have more equities. And as you get older, you switch it into bonds because bonds is like a fixed type thing that you get a certain amount at the end. But I've always questioned that because why don't you just live on the dividends from it rather than sell what you have? And then when you're done with it, you can give it to your spouse, she's done, or you're both done with that, you passed away, give it to the church, give it to your kids. There's no reason why equities can't remain a large portion right to the very end, because you hand it off. You give it to your beneficiaries, either your family or the church benefits. And so there's no need of putting it into what I consider not a good investment in most cases. You just keep equities and go with it. Just a thought.
Yeah, that one definitely relates to risk tolerance. So when you talk about passing that fund onwards, you've now extended your goal, right? But if we're talking about keeping that fund and living off of it in retirement, we've shortened that goal. So now we're in a shorter term goal versus having a longer term goal. And you raised another really great point, which is usually, speaking about mutual funds, those mutual funds that are paying out to people who are retired, they still hold some stocks. So we have a category of stocks that we call blue chip stocks. And these are companies that usually, if you own a preferred stock, pay a healthy dividend and experience very little fluctuation. So favorite blue chip stocks are banking stocks. They experience very little fluctuation, sometimes small jumps, and they pay that dividend constantly. So that is an equity that you could keep in that retirement type portfolio. But definitely if you have extended goals beyond just living off of your funding in retirement, then yes, keep your fund invested so that it can continue to grow and benefit whoever you feel is the beneficiary for that fund. Absolutely.
As a starter, what mutual funds you can recommend to the starters?
I can't recommend a specific mutual fund. So my advice would be to go to the financial institution that you're currently banking with, assuming it's one of the bigger banks, and start there. And let them recommend to you a fund. I know this sounds taboo and they won't like it, but go there, have the full entire conversation with them, take that prospectus document home, whip out your highlighter, and go through and decide if that's something that you want to do. That is the best place to start.
I'm just curious with ATV, that's not on your 5 listed of banks. So is that something that's not wise to go with when you're trying to do investments?
So it's not that it's unwise. ATB is Alberta Treasury Branch as a government of Alberta employee. It is the bank of the government of Alberta. Unfortunately, it is small. So while it seems big because we ourselves are in Alberta, it's small on the larger scale of the big 5. And so it's not going to have as many offerings. It's not going to have as much access as those big 5 banks, but it doesn't mean that their funds are bad. So if you already bank with ATB and you want to go there for your financial advice, similar to what I had told this gentleman over here, go there, ask for that prospectus, take it home and compare it. So if you compare that to a TD mutual fund or a BMO mutual fund, are you satisfied with the performance?
How much time do we have?
We're a little bit over.
We're over. Have we already applied the exchange rate? No. On the time.
Well, I would say this is very helpful because
Okay, all right. So we're going to continue this conversation with you. At the School of Business at Bremen University, we have what we call the Business Speaker Series, which goes from September all the way to April. This September, we're going to have an investor from an investment fair from out in Toronto. We have just received a message from him. He was going to come in person, but he said he would prefer to do it on Zoom. So if you can join us on Zoom, so we're going to circulate something in the room so that you can.
people here to have your name.
your name
address.
and your email address. We can send you the link. You can join us on Zoom on September 28th at 7 p.m. And you can ask questions on Zoom. It's going to be open, and we will continue that conversation. We're bringing professional and other professionals to have that conversation with you. I'm suggesting that it's not safe if you are like me, living on a paycheck, not to invest in the market. We need to explore the market and make some investment. Even if you are running your own business, it's safer to diversify your portfolio of assets. A couple of quick announcements here. I want to thank you for being here with us this morning. We're going to meet for the last session this afternoon, 3:30. And there's always some bonus when we meet and additional information we share.
Still a repeat though, just
So
just to be clear.
There is a bonus.
The stories may change.
And the School of Business at Birmingham University Birmingham University has received for the School of Business 600.